Welcome to today's video on maximizing your mortgage savings. We'll expose a common prepayment loophole that can cost you years of extra interest if you miss it, and we'll show you exactly how to close that gap. We'll cover the tenure trap, the must-send instruction letter, fee decoding, negotiation tactics, and a practical action plan. Stay until the end for key takeaways and a quick quiz to test your knowledge. Here's our agenda. First, we'll define the tenure trap. Next, we'll reveal the one instruction your bank needs to shorten your loan. Then, we'll decode mandatory loan charges and identify what's negotiable. After that, we'll walk through a negotiation playbook, followed by step-by-step instructions for writing to your bank. We'll visualize concepts with diagrams and reinforce learning with short quizzes. Before we begin, a disclaimer. This video provides educational information only. Mortgage rules, taxes, and documentation requirements vary by jurisdiction and lender. Always confirm specifics with your lender and consult a qualified financial or legal advisor before acting. We do not guarantee outcomes. Use this as a starting framework to ask better questions and negotiate effectively. Let's define the tenure trap. When you pay more than the required EMI, most banks will apply the excess to principal, which is good. However, many still keep your original end date and EMI structure. That means your interest savings accrue slowly over time rather than accelerating the loan payoff. To fully realize the benefits, you must proactively change how the bank recalculates your loan. Specifically, you need to request re-amortization with a reduced tenure so the payoff date moves forward. This flowchart illustrates two pathways. First, you decide to prepay. If you do nothing else, the bank typically applies the extra to principal, but leaves the original tenure unchanged. That yields slower savings. Alternatively, if you send a written instruction to re-amortize and explicitly reduce the tenure, the bank recalculates the schedule, bringing the payoff date closer and compounding interest savings. The key decision node is whether you send that instruction. Here's the crucial letter. You must ask the bank to re-amortize the loan and explicitly reduce the tenure. State your plan to continue higher payments, for example, doubling your EMI. Request a revised amortization schedule that shows the new monthly breakdown and updated loan end date. Finally, keep evidence. Send the request in writing, ideally via email and a physical letter, or through the bank's ticketing system, and retain their acknowledgement. This creates a paper trail that compels proper processing. To execute, first confirm the lender's prepayment and re-amortization policies, including any administrative fees. Next, draft a letter that includes your loan account number, property address or reference, and a clear request to reduce tenure via re-amortization. Specify the increased monthly amount or lump sum prepayment plan. Ask for an updated amortization schedule and revised closure date. Submit through official channels, keep records of submission, and follow up within 7 to 10 business days until you receive written confirmation. Use this sample instruction as a template. Include the subject clearly stating a re-amortization request with tenure reduction. Reference your loan account number accurately. State the increased monthly payment amount and your intention to maintain it. Ask for a revised amortization schedule and a confirmation of the effective date of changes in writing. Adjust the currency and details to your jurisdiction. Keep the tone professional and concise. Quiz time. If you double your EMI but do not instruct the bank in writing to reduce tenure, what most likely happens? Option A. The bank automatically shortens your tenure drastically. Option B. The extra pays down principal, but your original tenure often remains unchanged. Option C. Your interest rate is lowered by law. Option D. Your processing fees are refunded. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is B. In many cases, the bank will apply your extra payments to principal, but will not adjust your tenure unless you submit a written request for re-amortization that explicitly reduces the tenure. This is why sending the instruction letter is essential to unlock the full acceleration benefits. Let's decode typical loan charges. Some are statutory and generally non-negotiable, while others are negotiable and should be challenged. We will categorize each. Processing fees, statutory charges like stamp duty and CERSAI TDS thresholds, mortgage documentation such as notice of intimation, mandatory insurance to secure the lender's interest, and due diligence costs including title and search reports. Here's a typical breakdown. Processing fees are the most negotiable, Always ask for a reduction or waiver. Statutory charges like stamp duty and CERSAI are government mandated and usually non-negotiable. TDS applies above certain property value thresholds, such as properties above about 50 lakh in some jurisdictions. Confirm the current rules locally. Mortgage documentation costs, including notice of intimation, may be capped or bundled depending on lender and state. Mandatory insurance protects the lender's interest. You can often shop for a cheaper, equivalent policy independently. Finally, due diligence costs for title and search reports are essential for legal safety and should never be skipped. This table summarizes charges and how to approach them. Processing fees are often negotiable, so request waivers or reductions and leverage competing offers. Statutory charges like stamp duty and CERSAI are non-negotiable and set by government schedules. TDS is a legal requirement above certain property thresholds. Comply and deposit on time. Documentation fees, such as notice of intimation, can sometimes be capped or bundled. Ask your lender. Mandatory insurance is often negotiable. Consider purchasing independently with equivalent coverage. Due diligence on title and search reports is essential and should be thorough to avoid legal issues later. Comparing insurance options, the bank's bundled policy is convenient but can be more expensive and may include hidden commissions, with less flexibility on riders and terms. By contrast, purchasing an independent policy allows you to shop for better pricing and coverage, provides more transparency on costs, and enables customization of riders such as disability or critical illness. Ensure the independent policy satisfies the lender's requirements for sum insured and assignment if needed. This timeline shows a practical sequence. At month 0, you send the written instruction. At month 1, the re-amortized EMI reflecting a reduced tenure begins. At month 6, you verify that the schedule is accurate and the tenure is actually shortened. In year 2, if you can, make a lump sum prepayment and request re-amortization again to cut the tenure further. By year 3, you reassess. By year 5, you reach a significantly earlier payoff compared to a typical 20 to 25-year schedule. Second quiz. Which fee is most commonly negotiable across lenders? Option A, stamp duty. Option B, CERSAI registration. Option C, processing fees. Option D, TDS on property purchase. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is C, processing fees. These are commonly negotiable. Use quotes from other lenders to push for a waiver or a significant reduction. Stamp duty, CERSAI, and TDS are generally statutory and non-negotiable, though you should still verify the prevailing rates and rules. This mind map places home loan negotiation at the center. One branch covers fees, highlighting processing fees, insurance, and documentation caps, with actions like asking for waivers and shopping for policies. Another branch covers prepayment strategies, including higher EMI and the timing of lump sum payments. The re-amortization branch emphasizes the written request, tenure reduction, and obtaining a revised schedule. The compliance branch reminds you of statutory charges and TDS deadlines. Finally, documentation focuses on keeping receipts and maintaining an email trail. Here are the key takeaways. First, extra payments alone won't maximize savings. You must submit a written re-amortization request to reduce tenure. Second, request a revised schedule and explicit end date. Third, focus negotiations on processing fees and bank-sold insurance. Fourth, treat statutory charges and TDS as compliance items. Fifth, re-amortize after each substantial prepayment. Finally, preserve a complete paper trail for all communications and confirmations. Let's consider a simple example. Assume a 50 lakh loan at 9% for 20 years. If you double your EMI from the first month, but do not request a tenure reduction, you will still reduce principal faster. Yet the original end date may remain unchanged or not shift sufficiently. By contrast, if you double your EMI and request a tenure reduction via re-amortization, your payoff date can move forward by many years, resulting in substantial interest savings. Always ask for a revised schedule to confirm the new payoff date. To wrap up, your action plan is clear. Send a written request to re-amortize and reduce tenure. Negotiate processing fees and shop for independent insurance. Treat statutory charges and TDS as compliance items. And verify current slabs and timelines. After each major prepayment, Ask the lender to re-amortize again to keep your payoff accelerating. Maintain a complete record of all submissions and confirmations. Thanks for watching. If this helped you, please like the video, share it with someone who's buying or refinancing, and subscribe for more practical finance strategies. Tell us in the comments how much tenure you shaved off, or what your lender said when you asked for re-amortization. Your experiences can help others negotiate better.